The fabulous call that Stephanie Link made in Twitter. Let's bring her in fact, on the phone. Steph, you there?
I'm here.
Yeah, congrats on the move. I'm hearing from people, too, who want me to tell you congratulations and thank you. That's partly what this program tries to be, right? Giving people sound investment advice. And some people took yours and bought Twitter. And as I said, that stock's up better than 17%.
Yeah, I mean, it was a good quarter, but you know, the setup actually was very favorable heading in. The stock was down 27% from its high headed into the quarter, and you had just two analysts just in this past week issue cautionary previews. So the expectations were really low. That said, I mean, the quarter was really good. You mentioned average monetizable DAUs. Not only was it up 21% year over year, but it was up 5% sequentially. So that shows that the business is actually improving. Total revenues beat, up 11%. Ad revenues beat, up 12%. So all these numbers are good, and I think the real reason the stock has taken off is because the guidance actually was pretty good in terms of expenses. I had expected them to be much higher than 20%, and it was 20%. So overall, pretty good.
But what now? I mean, you're the kind of investor who looks at something like this and maybe from time to time thinks about trimming some of the position when you get a big pop like this. What do you do now?
I actually am looking to buy more. You know, today seems a little bit overdone, so if you get a pullback, that's probably what I would do. You've got catalysts. You've got the Olympics. You've got the election. You've got Europe 2020. You also have easy comparisons, and hopefully all these fixes, this expense growth, will lead to platform growth. So I like the story for 2020.
Okay. Joe, you want to get it? Joe's thinking about buying it. Did Stephanie just put you over the edge?
Steph, first of all, great call. But I also think sentiment plays a lot in Twitter and positioning. And Steph, let me know if you agree with this. If you go back in 2015, it appeared as though the stock was going to be breaking out. I think it had a high somewhere around $55. It proceeded to kind of just roll back down and was in a malaise for a couple of years. Both in 18 and 19, it made two attempts to break out. And in each instance, it failed. In December, we saw that washout. We saw that washout in terms of sentiment and positioning. And I think that could act as potentially the biggest catalyst. Why? Because if you get another quarter that represents a strong quarter like we just had now, that's going to surprise most people. I think there's still skeptics. I think, Steph, you would agree. There's skeptics if there can be consistency in terms of delivering the type of earnings that Twitter delivered today. That, to me, is the biggest catalyst, that turn in sentiment and the durability and sustainability of quality earnings over consistent quarters. Do you agree with that?
I do, and if you look at the sell side, there are only 8 buys and 35 holds or sells on this position. So the sell side is certainly not positioned for this stock to do well. And then you have to believe, though, that the expense growth will stay around 20% and that the fixes that they are putting into place will lead to better growth. I do like these catalysts, though. That's why I like it for 2020. I don't know about 2021. We'll have to see about the execution and the consistency. I think they're on the right track. I think the CFO is phenomenal. And but I do think that this year you've got these catalysts and easy comps, so they have a pretty low hurdle, if you will.